Good evening. I'm Richard Clarida, the C. Lowell Harris Professor of Economics and International Affairs here at Columbia, and it is a distinct honor and sincere personal pleasure to introduce our speaker tonight, Ms. Sheila Bair. I've known Sheila now for 10 years. I've worked with her in the trenches, seen her in action, and I can tell you that she's a remarkable woman who has had a most accomplished and indeed inspiring career. When you think about it these days in Washington, that combination of accomplishment and inspiration is pretty rare in these polarized times. Sheila, of course, most recently was the chair of the Federal Deposit Insurance Corporation, an agency created by FDR to ensure the safety and soundness of the banking system by providing insurance for bank deposits, and importantly, with the authority to unwind and merge banks that find themselves in distress. Now, I suspect that when she assumed the FDIC job in July of 2006, she had no idea that the worst financial crisis since the Depression was less than a year away. Nor did she suspect that she would be spending many weekends, late nights, and summer vacations in endless high-stakes meetings with Ben and Tim and Hank, Larry, Ram, and yes, even with Barack, as they together discussed, debated, and developed the policy options and plans to combat the crisis and restore the collapsed confidence in the financial system. Now, we weren't there, but Sheila was, and as becomes very clear upon reading her new book, which is available for sale in the lobby when you finish today. Thank goodness that she was there, the right person at the right time in the right place. You know, it's often said, including here at Columbia, that no good deed goes unpunished, and Sheila did indeed often meet fierce resistance to her efforts to cleanse the financial system of its many excesses tied to the doctrine that major banks are just too big to fail. But she also received bountiful accolades for her leadership during the crisis. She made the cover of Time magazine as one of the world's 100 most influential people. She received the JFK Profile and Courage Award from Caroline Kennedy and the Kennedy Library. She topped the Wall Street Journal's annual 50 Women to Watch list, and in 2009 was ranked by Forbes as the second most powerful woman in the world, just behind Angela Merkel and well ahead of Christine Lagarde. Now, prior to her appointment at the FDIC, Sheila was the Dean's Professor of Financial Policy at the University of Massachusetts at Amherst. She also served with distinction and vitality as the Assistant Secretary of the Treasury for Financial Institutions, which is where I worked with her 10 years ago. She was a Senior Vice President at the New York Stock Exchange, importantly, a Commissioner and for a time Acting Chair of the Commodity Futures Trading Commission. And she began her career as the counsel to legendary Senator Bob Dole of Kansas. And as she reports in the book, she was also a bank teller at one time. Sheila at present is a senior advisor to the Pew Trust and is chair of the Systemic Risk Council, a volunteer effort formed by the CFA Institute and Pew to monitor and advocate for improved financial regulation. So ladies and gentlemen, without further ado, please join me in giving a warm Columbia welcome to Sheila Bair.
Thank you, Rich. That was a very nice introduction, though I would like to clarify that I was actually the second most powerful woman in 2008 and 2009. And actually, there's some funny stories that go along with that. You know, I was, during the crisis, well, after the crisis, I was speaking at my daughter's all-girls school, Holton Arms, to some grade school students. And the principal, in introducing me, announced that, you know, I was the second most powerful woman in the world, and blah, 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 and that was very nice. And then I got up and started giving my remarks to these young women, and my usual spiel about banking and the importance of saving and all of that. And then when I was finished, a little hand went up in the back of the room, and she said, well, who is number one? And it's very hard to impress young people these days. It was Angela Merkel, but, you know, in I think it was 2010, I dropped to number 14, and I was behind Lady Gaga, and I was quite distressed about that. And then in 2011, as I was leaving the FDIC, I dropped off the list completely, but I was at the top of the list of people who dropped off. So there you go. I thank you. I really appreciate this invitation. I've been doing a lot of public speaking since I left the FDIC. And this may surprise you, but actually a lot of industry groups asked me to come speak to them. I think when my book came out, one of the headlines was Bair Mall's Bankers. I don't know that I think I try to treat the subjects in my book and talk about individuals and institutions in a way that is fair and candid. I did call some people to task. I think when I did so, I did not do that without justification. But I still do. I actually have an active dialogue with a lot of people in the industry. And, one of the questions they just keep asking me is, why does nobody trust us, right? Why does nobody trust us? And how can we get that trust back? And they're absolutely right. The public views of banks is at historic lows. Gallup did a poll last summer that showed that there were only 2 institutions that had a lower trust factor than banks. And can you guess? One were HMOs. The other was Congress, actually. So that's kind of interesting. But they do complain, and they should be worried about this, because trust, it's an old saying, but it's true. Trust is something that you have to earn, and once you lose it, it is really, really hard to get it back. And banks, I think, have lost, I should say financial institutions. This isn't just banks. A lot of this was going on in what we call the shadow sector outside of the traditional banking sector. But, they've lost regulators' trust, too. I think you can see that in the very tense relationships that we have observed with Dodd-Frank implementation. And I think this money market mutual fund reform issue really just underscores one of the reasons why there is such a strained relationship, because here you have a situation. I think you all understand money market mutual funds are an inherently unstable business model. With a money market mutual fund, essentially the fund manager says that we're going to pay you $1. If you give us $1, we're always going to pay you $1 back. Even if your investment isn't $1, right? So if it's more than $1 or less than $1, we're still going to pay you $1. And the problem is that assets do lose value in money market funds, and this happened during the crisis, and one of the major fund broke the buck, and it was a terrible contributing event to the system seizing up after the Lehman failure. And so this needs to be fixed, and taxpayers had to come in and do a bailout, and my gosh, we saw this happen. We know it's an unstable model. We know taxpayers had to come in when they should never have had to do that and bail these funds out. And, 4 years later, it's not been fixed. And so Chairman Shapiro, the chairman of the Securities and Exchange Commission, which has the lead authority for fixing this problem, they are the lead regulator of money market funds, had put some very good proposals out. It got overwhelming bipartisan support, ideological support. This is one thing the Wall Street Journal editorial board and the Post agreed on, right? We got to fix money market mutual funds. And Chairman Bernanke, Secretary Geithner, just about everybody in the regulatory community said this needed to be fixed. And she could not get the votes to get this out, even for comment. Even for comment, she could not get the votes. The money fund industry was just vociferous in its attack on these proposals. It spent tons of money, tried to gin up trouble on the Hill, and focused very hard on 3 commissioners. And the third vote on this, who stopped this even being proposed for comment, was a Democratic commissioner. And I'll never forget reading the papers the day this came to light. And he said, the industry was telling me one thing, and the SEC staff, they were telling me something else. And so I decided, since there wasn't agreement, that we shouldn't move ahead. And I thought to myself, wow, it wasn't just the SEC staff. It was the chairman of the SEC. It was the chairman of the Fed. It was the current and former, Hank Paulson also weighed in on this, Secretary of the Treasury, the current and former chairman of the Federal Deposit Insurance Corporation. You saw what happened in 2008. And yet, because there were industry lobbyists coming to him and saying, well, we don't think this is right, he was then willing to even put this out for comment. I just find that astonishing. But that is the brute force that the industry continues to exert on regulators as they try to implement Dodd-Frank. I think a lot of the rhetoric has really been misleading as well, and I think that's very unfortunate. That's one of the reasons I wrote my book. I want to try to cut through all the half-truths and myths and at times just out-and-out lies about what happened, why it happened, what needs to get fixed, and what still hasn't gotten fixed. And I've tried very hard to write this in an accessible language because I want a broad Main Street population to understand where we are and how we got here and what we need to do to get out of it. And the public is angry, and I don't blame them. They're cynical. They don't feel like they can trust anyone. They felt that they were, gamed by the industry. They feel like they were gamed to some extent by the regulators, and I think the regulators did, leading up to the crisis, fall down on the job. If it makes them feel any better, I was gamed too. I have some anecdotes of information, my own experience with industry lobbying, which I think somewhat underscores the point of why there is this lack of trust. So when I first became chairman of the FDIC, as Rich mentioned, this was in the summer of 2006. And because of industry lobbying, for years, the FDIC had been prohibited from charging premiums to pay for the deposit insurance that we provide banks, unless the bank had a very weak supervisory rating. So and that was only about 2% of the banks. So the vast majority of the banks, 80% of the banks, Congress had banned the FDIC from charging them any premiums for the deposit insurance, so long as the reserve stayed above a certain minimum level, set at 1.25% of insured deposits. So the FDIC finally got this taken care of in early 2006, shortly before I arrived there, because it was terrible. I mean, this is a big benefit for the industry. Everybody should pay something. And what was going on was you would have new charters come in, and these rapid growth banks who had never paid a cent of insured deposits, getting this tremendous government benefit. And it also kept the agency from building the fund up in good times to deal with problems that occur when a cycle hits. And, we start having bank failures and we start having losses for the deposit insurance fund, the reserves that the FDIC kept. So within 2 weeks after assuming office, I put a rule out for comment raising insurance premiums for all banks. And it met with a firestorm of criticism and opposition. And the arguments were that we didn't need the money because the industry was healthy, right? It was the golden age of banking, hadn't had a bank failure for 3 years. There was no reason in the world why the FDIC needed to start charging premiums for deposit insurance. And we heard that old saw, which I hear constantly: you're going to constrict our ability to lend if you do this. Boy, every time a regulator has to regulate, I hear that. We're going to constrict the ability to lend. So we went ahead and did it anyway. I'm proud to say there's one instance where the regulators did stand up unanimously, and I credit my board at the time for standing up. And we did start collecting in premiums. Unfortunately, it wasn't enough to build up enough of a cushion before the crisis hit. And so later, as bank failures were occurring and our deposit insurance fund was depleting, I was darned if I was going to go borrow from taxpayers. We had the ability to borrow from Treasury for money, but I wasn't going to do that because, the industry had been the reason why we were not able to build up our fund to begin with, and I was going to go back and assess them. This was their insurance fund. It was their responsibility, not taxpayers. So we went out and we did several assessments on them, and guess what I heard then? You can't assess us. The industry is stressed. We can't afford it now. So there you go, So in good times, the industry is healthy. Don't assess. We don't need it. In bad times, the industry is stressed, so you can't do it. Another example, again, early in the crisis, in late 2006, we were trying to move ahead with the mortgage lending standards, especially for subprime. It was kind of obviously needed. Lending standards are getting completely out of control. And we met a lot of resistance, I'm sorry to say, from some of the other regulators, but more importantly, from the mortgage banking industry and the securitization industry. And so in January of 2007, a bunch of them asked to come in and see me. And it was one of those intimidation meetings that I'm sorry to say I've had too many of these, where about 25 of them come in and they're sitting around the room and they're trying to, beat their chest and tell you what a bad person you are. Mm-hmm. And so they said, well, you can't tighten subprime lending standards. They said, you're going to constrict credit. There you go. We were going to deny credit availability to lower income people if we tightened lending standards. And I said, well, we want you to make loans. We want you to make prudent loans. And these loans are going bad because even in early 2007, the subprime delinquency rates were going up significantly. And then they said, I can't, and then they started bashing borrowers. So on the one hand, they were saying, oh, you can't tighten standards, it's going to constrict credit. And then they started bashing borrowers and said, oh, no, that has nothing to do with the mortgages. It's not that these are bad, poorly underwritten payment shock mortgages. It's just that people don't care about making their mortgage payment anymore. If they have, they have another expense like a washing machine or something to buy, they just go do that instead of paying their mortgage. And I was offended by this. I kept saying, these people, what is this? On the one hand, you say that you're trying to help homeowners, and on the next hand, you're saying that you're making these derogatory comments, and it was obvious that it was the loans. It wasn't the borrowers, it was the loans that was causing the problem, at least for subprime at that point. So we did finally get lending standards tightened in June of 2007, which is lightning speed for bank regulators, but unfortunately by then a lot of the damage had been done. And there were these millions of unaffordable mortgages out there, and we knew as the housing market was turning, these mortgages had really steep payment resets. They were a refi product, right? So every 2 or 3 years there would be a steep payment reset, and the way they were underwritten, the borrower couldn't afford the payment reset, so they'd have to refinance. But with home prices going down, they couldn't refinance anymore. They didn't have enough equity. So we said, you know what, let's get rid of these payment shocks. Let's just convert these to 30-year fixed-rate mortgages. And the sad part about the subprime, there are other types of mortgages called Alt-A that were really used by the flippers and the professional investors and the people who are trying to game the system. But these subprime loans were really heavily marketed into low-income neighborhoods. And by and large, they were refinancing people who had safe 30-year FHA fixed mortgages were getting refinanced out of these mortgages and put into these subprime loans. They were called 228s and 327s with the steep payment shock after a few years. So we said, let's just get these restructured en masse. They're all going to go bad. They can't afford the payment reset. Let's just convert them to 30-year fixed. And we actually had the industry in, and we had some of the other regulators in, and I thought we had a commitment to do that. And so we waited, and the fall of 2007 came, and foreclosures are spiking up. And Moody's.com did a report that showed that less than 1% of these distressed subprime mortgages were getting restructured, and they were all just going into foreclosure. So I went to New York to speak to a securitization group, and I said to them, why aren't you restructuring these mortgages? You told us, we just had these round tables, we established you had legal authority to do it, you said you needed to do it, the foreclosure losses were going to be huge if you didn't. And, people are looking sideways, and I thought they were going to throw rotten tomatoes at me. And so I finished my remarks, hand goes up in the back of the room, and here was these people again. You can't help these people. If we restructure their mortgage and lower their payment, they're just going to go out and buy a color TV. And I said, well, if you feel that way, why did you fund the mortgages to begin with? And I'll never forget, they said, bad regulation. So there you go. In January, if I was trying to tighten lending standards, I was constricting credit. But by October, when things were blowing up, it was all my fault for not tightening lending standards. One final example. I don't want to belabor this, but I think it touches on some really key reforms that still are not getting done, and that concerns capital requirements. I spent a lot of time in my book talking about capital requirements. I implore all of you who get the book, and I hope you enjoy it, stick with me on capital, because I tried to make it, people's eyes glaze over to the Basel Committee, bank capital standards. I know it can be dry as dirt, but I tried to make it interesting because it's really, really important to understand. Capital at the end of the day is just the amount of money that a bank's owners, their shareholders, have to put up of their own to support their operations versus the amount of money they can borrow, right? So there are two types of capital standards. One is what's called a leverage ratio, which is a simple, the amount of common equity, the amount of money your shareholders have put into your operation as compared to your total assets. And then there is another type of capital ratio called a risk-based ratio that allows banks to adjust their assets based on risk, which basically says you can hold less capital and take on more leverage if you say your assets have less risk. So in 2006, somebody had gotten the bright idea of having a new capital standard that basically let banks make their own decisions about how they're going to risk weight their assets, which meant banks were going to be making their own decisions about how much capital and leverage they could hold. And we fought that tooth and nail. It was implemented in Europe. It was implemented with the investment banks here. I'm proud to say the FDIC fended it off for the banks that we insured, and thank goodness we did, because it really saved our bacon. But I and the FDIC were completely isolated on this. I was getting hammered by the Hill, Chuck Schumer, all the big banks, Mayor Bloomberg. I think he's changed his view now, but everybody was just beating up on me, and they were saying, you can't make our banks hold higher capital than Europeans because it's going to put them at a competitive disadvantage if you do that. And my response was, and McKinsey did a big report that the City of New York commissioned on this, and my response was, no, I think banks with high capital levels are safer banks. They're more stable banks. They're not wildly speculating with other people's money. They're putting their own money at risk, and because you have to put your own money at risk, they take fewer risks. So it's a competitive advantage, not a competitive weakness to have higher capital standards. Well, fortunately, we were all able to hold that off. But now, we, and I as a member of the Basel Committee, which is an international group that sets bank capital standards, I engaged in a new process called Basel III, where basically we tried to fix this terribly flawed capital accord that basically let big banks set their own capital, which we had not implemented. And so we did get it fixed with Basel III. Well, we didn't get it all fixed. We got a lot of it fixed. We got a new leverage ratio, which constrained really having a low capital because you say your assets are safe. And we made a number of other improvements. And one of the most important things we did for the very largest institutions, we said, your capital has to be higher, right? Regular banks, traditional banks, we don't worry about them so much. You're a big mega institution with trading books, derivatives. We're going to make you hold higher capital. So guess what we're hearing now? You can't require big banks to have higher capital. That just means that they're systemically important and they're too big to fail. That gives us a competitive advantage. So, so when they wanted lower capital, that was a competitive advantage. Now higher capital is a competitive advantage. And you have experiences like this, and it just kind of makes you want to stop listening. So, I do think this is a real issue for the industry, and it's not everybody in the industry. My gosh, there are really a lot of very good people in financial services and good leadership, responsible corporate players, but they don't really speak up. We saw that pre-crisis trying to get, mortgage lending standards, I was trying to get that done as early as 2001 when I was at Treasury. Just couldn't get it done because of this relentless industry lobbying. The bank capital standards, we should have been raising capital prior to this crisis. We had an overheated housing market. We should have been raising their capital to get ready for the big one, right? Not lowering capital, thinking that the good times were here forever. But that's what we did, and that was because the industry lobbied heavily for it. But the regulators capitulated to it. We all kind of got enamored with this idea of self-regulating markets. But there were some people when I was trying to raise insurance premiums and we were trying to tighten lending standards. I'd have people, calling me on the phone, secretly saying, "Yeah, Sheila, go," but they wouldn't speak up. And I think now, if you're going to restore trust, the good players in the industry have to speak out. They have to constructively engage, because the best regulation will have good input from responsible people in the industry. But I'm afraid those voices have really been drowned out by a lot of very vociferous, irresponsible lobbying. And that, in turn, undermines public trust, because now what you're seeing is people see that Dodd-Frank is not being implemented, and so they're losing confidence in the regulators. They already don't like the industry. And that is really against the industry's own long-term interest, because if you're a bank, or if you're an investment bank, commercial bank, if you're a financial institution, if you're dealing with other people's money, your customers' money, your business model is all about trust. And if you don't have that trust, you're not going to have a sector that is going to ever get back to a healthy status again. And your public trust is also going to relate to public trust and regulators. And if the public thinks the regulators are outgunned or outmanned or corrupt, or if the industry ridicules them, and goes to the Hill and blasts them, then that, at the end of the day, that also, that definitely hurts their trust. It's very short-sighted. That's not to say that regulators are not at fault. There are a lot of things clearly regulators could have done better prior to the crisis and could do better now. I really am very disappointed by how complex a lot of these rules are coming out of the Dodd-Frank implementation process. Dodd-Frank, it's not a perfect law, but we are much better having it than not having it. But at the end of the day, Dodd-Frank was really a directive to regulators to write the rules to fix this crisis. But the rules are, there's, I think, only about 30% of them have been done. There have been big delays in getting them even proposed for comment, and sometimes, like money market fund reform, just stopped in its tracks. So perhaps that can be revived. And when they are proposed, and the Volcker Rule is a prime example of this. The Volcker Rule is very controversial. A lot of people in the industry don't like it. But really, at the end of the day, it's just about saying that if you're a safety net institution, if you're a bank holding company, you have access to deposit insurance and the Fed's discount window, that you should be you should be doing things to help business customers and households. You should be providing loans and providing credit intermediation. You shouldn't just be speculating out there for a profit, taking a gander on complex derivatives or whatever. But it's a simple concept, and it is difficult to write. But my gosh, what the rule that the regulators put out is hideously complex. It's full of exceptions. And I think one of the reasons they did that was because they were trying to accommodate some of the industry concerns. But what happened was the industry lobbyists turned around and said, and ridiculed the regulators and said, look at this Rube Goldberg contraption. There's no way we can understand this or deal with this. And so I do think that regulators need to understand they're on their own on this. And until we can get industry people to more constructively engage, I think they need to, you always need to listen to everybody, but you just do what you think is right. And don't put all those exceptions in there, because all it's going to do is make the rule more complex, easier to game, and the industry will always move the bar on you. That's just the way things are operating in Washington right now. I do think, too, though, that there are things that, one of the reasons that perhaps regulators aren't as independent as they should be, I think there are a couple things. One is there's a lot of political pressure, and in Congress, I do fault them for this. Brooks Born is the prime example. When she raised her hand in, I believe it was 2000, and said, you know what, we've got this huge off-exchange derivatives market, and nobody's regulating it, and nobody really knows what's going on, and we need to have, we need to put some basic safeguards in place. She got her hat handed to her. Congress passed a law taking the CFTC's authority completely away over OTC derivatives, and while they were at it, they took away the SEC's authority and all the state insurance regulators too. They just completely deregulated that market, and as a result, when the crisis hit, there were lots, trillions and trillions of derivatives contracts that had been written that were based on how those mortgages performed. We didn't have a clue what that was about. Nobody had a handle on it, and I actually think that if it had just been the mortgages, we would not have had a crisis. We would have had a downturn. It would have been nasty. We could have handled the losses on the mortgages, but all the structured products that were based on the performance of those mortgages really was what caused the problem. And because of this law, the Commodity Futures Modernization Act, nobody really had a handle on what was out there. And and that was one of the reasons I think the regulators were caught flat-footed. I do, though, think that the revolving door is a problem with regulators, and that's not to say that there can't be people of integrity who hold regulatory positions and then go work for the industry or law firms or accounting firms or what have you and represent industry. But I do think, from a structural standpoint, it is a problem. And unfortunately, it has kind of become a way of doing business in Washington. And I made a point of not having that career path when I left the FDIC. But as I say in my book, I do think there should be permanent bans on regulators going to work for the industry, because it just skews your judgment, at least for examiners. I would really like to see examiners be more like the Foreign Service. It's a lifetime commitment. You do that, you're paid well, you're trained well. It's a prestigious job, it's a job of stature, but that's what you're going to do. And when you leave, you're going to go teach an academic institution or work at a think tank or whatever. But I do think the revolving door is a problem. And I do wish that the regulators, especially the top leadership of these agencies, would be more cognizant of the appearance of going to work for the industry or represent, be a lawyer and represent the industry, because it really sets a terrible, I think, tone at the top too, for people lower down. So I do think there's some reforms there that would be helpful. But at the end of the day, if the public doesn't trust the regulators and they don't trust the banks, then we're going to have a system we have now where the banking sector and public confidence rates right above HMOs. So I think the other problem is that with this constant fighting against the regulators to try to put these reforms into place, what you have is a situation where for 4 years now we've been struggling to just fix the problems we knew were problems leading up to 2008. Money market mutual fund reform, I already mentioned. Tighter capital standards, we still don't have tighter capital rules. They need to be increased significantly. We still don't have mortgage lending standards. We still don't have a structure in place to require these trillions of off-exchange derivatives, which are now bilaterally traded. It's a big daisy chain, if you know how this hat works, but one big bank, it's a very concentrated market. One big bank will have a derivatives transaction with another big bank, and then that big bank will have an offsetting transaction with a third big bank, and it just goes on. And you can't, it's virtually impossible to trace it back to who, at the end of the day, who's the dumb bunny holding the ultimate risk. And we found out it was AIG during the crisis, but we still don't know now, and that's why it's important to get this into centralized clearing. The clearinghouses are regulated. They are the central counterparty to all of these trades, but we still don't have that either. And the problem is these are things we know have to be fixed. We knew they were a problem in the crisis. We knew they were a source of instability, and it's just still not getting done. And the problem is, of course, is that there are new risks floating on the horizon. And so we still have regulators struggling, looking in the rearview mirror, trying to fix things that brought us the 2008 crisis. And the risks ahead of us are very different. Monetary policy. What in the world are going to be the ramifications of this protracted zero interest rate policy? We just don't know. And at some point, the Fed is going to have to get out of this. And if you'll recall, in 2006, the Fed had pretty accommodated monetary policy leading up to the subprime crisis. And one of the reasons investors were investing in subprime is because they had a high rate of return, because the safe investments were a very low rate of return because of very low interest rate policies. But when the subprime crisis started in 2006, when the Fed started to try to bump up interest rates. And I think the Fed has all the best of motives with trying to keep rates near zero for this very long period of time, but at some point they're going to have to exit. And the longer you keep these policies in place, a couple things happen. Very low return assets build up on bank balance sheets, and at some point when interest rates go up, this is what we had during the S&L crisis. They've got longer dated, low return assets, but their liabilities, their deposits, the things they have to pay to fund themselves. Those interest rates are going to go up. What happens if inflation gets out of control? How does the Fed get out of this? They're going to have to raise interest rates to contain inflation. It's a real risk, and the benefits that you look at are from this very extended, very protected period of zero interest rates. It's just hard to see them now. During the crisis, absolutely, they had to do it. Fiscal policy is very much related to that. I'm not an austerity advocate, but I am a fiscal responsibility advocate, and I do think there needs to be some type of long-term plan to deal with the unsustainable path we're on. And the only reason Treasury can borrow so cheaply now is, one, the Fed's buying a lot of the Treasury debt, and two, we're still looking better than so many other countries. I joke we're the best-looking horse in the glue factory. But, what happens if investors lose confidence? What happens if, Europe gets their act together or another country becomes a more attractive bet to investors? That could also be highly destabilizing to our financial system. And so these are very real risks, and they really aren't, what bank regulators call credit risk was really at the heart of the subprime crisis. Credit risk, the risk of the loan going bad. Interest rate risk is what I worry about these days, and liquidity risk, the cost, your ability to keep funding yourself at reasonable cost. If you get into a volatile interest rate environment. And those are the things I'm afraid of that we're not even dealing with because we're still struggling in the past. So how does this get fixed? I think the public needs to engage, which is another reason why I wrote this letter and another reason why I like speaking to groups like this. These problems are not hard to fix. Raising capital requirements is not hard to do. Requiring central clearing of standardized derivatives products is not hard to do. But I think there may be some self-interest of those who don't like those reforms to make it hard, to make it complex, and it's not. And so I tried very hard in my book to explain these concepts in very basic terms. And I do think that people just need to engage. And I know you're all busy and have better things to do perhaps than understand what the Basel Committee is. But you know what? I don't see it that it gets changed unless people really make this a mainstream political issue, just the way the economy and jobs are key issues. I think getting financial reform, getting a responsible, stable financial system in place that serves your needs is really got to be at the top of everybody's list. So, you know, Robert Frost once famously said that life goes on. And that is true, but financial abuse does not have to. But we can't get this fixed unless regular people start, like you and me, start asking their members of Congress about it, start asking the presidential candidates about it, and don't accept nonsense. I mean, the next time you read about the LIBOR scandal or J.P. Morgan Chase's London whale, get mad about it. And don't accept, well, they didn't have information or blah, blah, blah. You know, after Dodd-Frank, the regulators really have all the tools that they need, and Congress should be supporting them in dealing with these issues, not trying to take away their funding or writing them nasty letters or hauling them before Congress and holding hearings. And I would just let people know that this is important to you, because at the end of the day, we do need those banks, whether we want them or not, and they are important to the financial stability and the growth of our economy. So thank you very much for letting me share those thoughts with you, and I'll be happy to take a few questions from
Well, Sheila, thank you so much for those remarks. The format is Sheila and I are going to have a conversation for several minutes, and then there'll be plenty of time for questions from the audience. So I do request that during the Q&A period that it is a question, not a polemic speech. We'll have time for those during cocktails, but a question, please. So, but as the organizer's prerogative, I get to lead off. As I mentioned in my opening remarks, I mean, you not only were, a witness to history, you were, making history, and I like your perspective. I think you suggested in the book, we have you here, so I'll ask you point blank. In September and October of 2008, how close was the global financial system to an outright collapse?
Well, I think it was in danger of spinning out of control. There's no doubt about it. We didn't have good information. But funding costs were going up significantly. Even healthy institutions were having trouble rolling their debt, which we call a liquidity problem. From a solvency standpoint, though, I don't think we had a major problem, at least for the commercial banks. As I said in my book, I think there were two institutions, Citigroup and Merrill Lynch, which had arranged to sell itself to B of A, that had significant solvency issues. But for the rest, it was really more of a liquidity problem. But there was a real concern about the things spiraling out of control. There wasn't good information. And the markets were definitely spooked after the Lehman bankruptcy. And that had made everybody suspicious of everybody else, which was another reason why it was difficult for financial institutions, even ones with relatively healthy balance sheets, to roll their debt. But the markets were still open to most institutions. For instance, the healthy commercial banks, both J.P. Morgan Chase and Wells have been able to access the markets to do acquisitions and raise a lot of capital. Goldman Sachs and Morgan Stanley, which were in more tenuous conditions, were able to access capital from non-governmental sources. So it was dire, but looking back on it, as I've said in the book, I think perhaps that we overreacted. It was particularly in 2009 when the system was already stable and we could have imposed some accountability. We didn't. But in 2008, we were dealing with the unknowns, and the instinct at that point is to throw a lot of money at it, which we did. And I think in the short term, we were successful in stabilizing the system.
And it's important to note and remember that a lot went wrong in the crisis, but importantly, we did not have any bank runs in the U.S., and there were countries that did, for example, the U.K., and Sheila won't brag, but obviously the fact that the FDIC had the credibility going into the crisis is important. Let me turn to the too big to fail doctrine. It was actually a made-for-HBO movie. In fact, you were an actress, played you in it. And there was, from our childhood in the 60s, there was a movie, Dr. Strangelove, and the subtitle was How I Learned to Love the Bomb. So do we have to learn to love Too Big to Fail? Are we stuck with it? Is there an alternative?
No, I don't think any institution is too big to fail. And we do have tools now that we didn't have prior to the crisis, and I think they are effective tools, and there's debate about that, but I will give you my personal perspective, is that I think, during the crisis, one of the reasons the FDIC and the insured banks functioned relatively smoothly is we had a process for insured banks. If they got into trouble, we had a process in place to deal with them, and one that's a pretty harsh process. For non-banks, though, for the AIGs or for the investment banks or even at Citigroup, a lot of these banking organizations, within them they'll have an insured bank, but a lot of the activity, especially the high-risk activity, will be going on outside of a bank, the insured bank, into other parts of the organization. There was no way to deal with those institutions holistically. The FDIC only had the insured bank piece, but the rest of it had to go through a bankruptcy process. And there are problems with the bankruptcy process, and it gets into technical issues of how derivatives contracts are treated, but I think that was the biggest problem with Lehman, is that they had a very good-sized derivatives book, and the way bankruptcy deals with derivatives is highly disruptive. The way the FDIC process deals with derivatives is much better. We can actually require, in bankruptcy, derivatives contracts can be, actually counterparties have the right to repudiate the contract if their counterparty goes into bankruptcy. In an FDIC resolution, we can take control of the organization and require that counterparties continue to perform to avoid that disruptive impact of contract repudiation. So that is the process we now have for large financial institutions, both banks and non-banks. If they're determined to be systemic, we can put them in an FDIC resolution process, which also provides some temporary funding to keep the institution operational as it's wound down and resolved. That process also requires these large institutions to file what's called living wills. They basically have to come to the FDIC and the Fed and say, if we get into trouble, we can be resolved in a bankruptcy process without systemic ramifications. And if they can't make that showing convincingly, then the Fed and the FDIC right now have authority to break them up or to require them to restructure or downsize. So there are, like in a lot of Dodd-Frank, the tools are there. The importance is to use the tools, but I think there's been some progress. The rating agencies have downgraded most of the major banks. Haven't completely gotten rid of the idea that the government would help them, but they have downgraded them based on the view that it is at least much less likely that the government will bail out these institutions than it was prior to Dodd-Frank, and I take that as a positive sign. A lot of people say, well, maybe the market won't believe it until you actually have to use it, and that's a heck of a deal, and I hope we don't have to do that. But I do think I have a lot of confidence in my former agency, and I think they've put a lot of information out already about how these institutions would be resolved. And it is quite harsh process. Not only do the shareholders and the creditors take the losses, and by the statute mandates that responsible executives and board members have to be fired. 2 years of their compensation has to be clawed back. You don't even have that in bankruptcy. So I think that sends a pretty strong signal to the management of these very large institutions that they can't come to the government for help again, and if they fail, there are going to be very severe repercussions for them personally.
In your book, you have a very powerful passage about groupthink leading up to the crisis, and how you sometimes felt sort of like, the skunk at the party when you were raising questions. But we can revisit that if you want, but I'd actually like to move it forward, because both in the U.S. and around the world, there's a lot of talk about macro-prudential policy, broadly speaking, using tools other than interest rates to influence credit. And at least one concern many people have, and I share this, is that when the times are good, it's very tough to do the sorts of things that macroprudential would call for. So do you think that's still a risk going forward? We have the FSOC, you write, the Stability Oversight Council, so maybe you could talk about how the FSOC is working or could work.
Well, I do think the regulatory tools, yes, regulatory tools can complement monetary policy. As I said earlier, I think if we'd raised capital standards as opposed to lowering them pre-crisis, we could have, one, constrained some of the wild and free credit that was going to the housing market, but also make sure that these large institutions had a capital buffer to absorb their losses when they hit. So I do think that is what needs to be done. Whether regulators have the will to do it, whether the politicians will let them do it, is quite another question. But I think that just feeds into the larger issue, which I've tried to engage tonight, is that we need to understand that regulators sometimes have to make some unpopular decisions, and ones that lend themselves to, allegations that we're constraining credit or making it harder for consumers to get loans or whatever. And I think a lot of that is rhetoric. I don't think it's true. But at the end of the day, the regulators really need the political support and the broad public support to take those hard steps to raise capital when the housing frenzy is occurring, and saying, you know what, you need to document your income and have a little bit of a down payment before you can get a mortgage. I mean, those are exactly the kinds of things. Not only are they prudent, but they can also curb asset bubbles growing and things spinning out of control the way we saw in 2008.
One last question from me before we throw it open to the audience. And obviously you discuss this in the book, but for the larger audience, is there one or two things that you saw and you learned viscerally from the crisis that, as is often the case, was caricatured or misreported in the financial press, since it became basically a daily soap opera? But is there something, because I know from my limited time in Washington, there are things that you observe and then you see the way they're reported and those are totally unrelated. So are there things that you viscerally, a message you want to get out about what you saw and it's just not well understood?
Well, that's a good question. I think one of when I became chairman of the FDIC, the late Bill Seidman came to see me, and he said, you know what, the FDIC is all about public confidence and getting the message out and the information out about what you're doing and who you are and why depositors don't need to worry about the safety of their deposits. And it's a constant management issue to deal with the media, be accessible to them, and constantly getting your message out. And he was absolutely right. And there were probably a lot of things said and done during the crisis that I spent a lot of my time correcting. I think one of the, thank you, Rich, because I think, the FDIC really did prove itself. We were there. We never had to borrow from taxpayers. We did not only protect insured deposits, but the access was seamless. Within 24 hours, I actually had one of my management initiatives when I came there. I had something called stretch objectives that just had to be met. And if they were met, everybody got an extra bonus. There were corporate-wide objectives, but they really were just do-or-die things. At the top of the list was you had to have any insured depositor of a failed bank had to have access to their money within one business day. And we never met that. We never missed that. And that was important. So you all, you have your money in your checking accounts. You're paying your bills with it. How would you like to, have even a few days not having access to that money? But public confidence was a constant challenge, and we really fought off a lot of skeptics who kept saying we were going to run out of money. If I heard that once, I heard that 1,000 times. Or the FDIC is going to run out of money. And there was, early on in the crisis, there was a little bit of unsettled activity on this, and we just fought it tooth and nail. And I'll give you a good anecdote. I was flying out to San Diego to speak to a banking conference, and I'm sitting there in the plane, and a young man comes down the aisle, he looks down at me, and he says, are you Sheila Bair? And I said, yeah. And he said, holy cow, you must be running out of money. They got you flying in coach. So I stood up, calmed everybody down, and said, no, we're fine. We've got plenty of cash. Because we did. We did have the deep pockets of the government behind us if we had to. Fortunately, we never had to tap into that. And I think, too, now looking back on the bailouts, I think there's just been so much misinformation. I think, that I do think we should have imposed a lot more accountability, especially in 2009, once the system was stable. And I very much regret that we did that. And I think people, and I also felt very strongly that we should have spent more money on restructuring mortgages, which is really the heart of the problem, where, we really just, the whole philosophy of the bailouts was to put the money in the financial institutions and get them healthy again, with the reasoning being that would support the broader economy. And it just didn't turn out that way. And I think people are still very cynical and angry about that. And I think that's a really unfortunate legacy of the bailouts. I do think there's another myth that circulates around, is that somehow this happened because the government wanted poor people to have mortgages. I mean, I'm sure you've all heard that. I say greed fed this. I mean, it was just absolute greed. I mean, getting mortgages to poor people may have been a rationalization, but all the money that was made off of this, and the front-loaded fees, and the bonuses, and the shareholders for, during the go-go years, the huge dividends, the huge bonuses, this was a huge money-making machine that was based on a flawed, actually the business model was called I'll be gone, you'll be gone, right? So originate the mortgages up front, sell them off to vulnerable investors, and you'll be gone by the time the mortgage blows up. There was, the GSEs did play a role, that Fannie and Freddie, and they're often accused, this is them driving it and wanting the government telling them to help poor people get mortgages. That's really that's not the case. And Fannie and Freddie are right in that the mortgages that they bought and backed themselves were much higher quality mortgages than those that were in these private label, these Wall Street securitizations, what's called private label mortgage-backed securities. But where I will fault Fannie and Freddie was that they made that market. They had a nice little operation going. They would issue debt that everybody assumed was backed by the government, so they could issue really cheap debt. And then they would take that cheap money and they would reinvest it in securitization investments that Wall Street had put together. So they were funding these subprime mortgages by being the investors. And I also am very disappointed in Fannie and Freddie that once we needed to restructure these mortgages and try to preserve home ownership, they exercised no leadership whatsoever as the biggest really AAA investors of mortgage-backed securities. They didn't do that. I have a chapter in my book called Stepping Over a Dollar to Pick Up a Nickel, and I do think it was indicative of some of the attitudes of the senior tranche, what we call the top-rated investors who held these mortgage-backed securities, as they just wanted to hold on to their returns. And even when we could see these mortgages going bad en masse, instead of supporting wide-scale systematic loan modifications, they still wanted to go loan by loan and squeeze out every little penny you could from these very distressed borrowers. So I do think Fannie and Freddie had a role in this. It's a little bit different from the narrative that we've heard otherwise. But the idea that this got started because the government wanted poor people to have mortgages is just wrong. This was greed that drove this.
Okay, well, we've got some time for questions and answers from the audience. We have microphones that are in the aisles, so if you have a question, please approach the microphone, ask your question to Sheila. Please keep it as a question. Yes, right there. The lights are on, so I won't be able to recognize you by name. But okay.
I just have a question about orderly liquidation authority. The FDIC has a lot of experience winding down regular banks.
Right.
And Dodd-Frank gave this as a tool for winding down larger banks. And
right.
A little bit of what your thoughts are on that.
Yeah. Well, it's right. It's different. But I think we've hired more people. I started an Office of Complex Financial Institutions before I left. We hired more people. We're working with the Fed, and I still say we, they. There for so long, it still be a we. I think the living will process, too, is huge, and requiring that they come forward and show that can be broken up. But part of this, I think, needs to be simplifying the legal structures of these very complex financial institutions as well, and they have the tools to do that. Again, the regulators need to use these tools, but a lot of these institutions are complex, but needlessly so. A lot of it is they have all these different divisions because they were trying to arbitrage legal requirements or accounting requirements. So I think making them simplify their operations would be important for regulators' preparedness and dealing with them to get into trouble, but also I think it'd help investors to understand what they've invested in. That's a good question.
I believe, let's go over that. So I believe Padma?
Me?
Yeah. No, right there, yeah.
Thank you very much for coming to us, Ms. Blair. I have a question about the ongoing controversy regarding regulating the money market funds to which you referred. And the two questions which are referred to are whether their share valuation should be made more flexible, and secondly, whether they should also be required to keep capital backing.
Right.
Would you like to comment on how would you handle these?
Well, yeah, no, that's a really good question. I like what's called a floating NAV, a floating net asset valuation. So basically, make them operate the way any other mutual fund operates, is that the value of your investment is what the value of that, reflected by what the value of the underlying assets are. Because now you have a guarantee of no loss of principal, that your share will always maintain $1 a par value, even if the assets that the fund is invested in are worth less than that. So I do think money market funds got started as a regulatory arbitrage. They wanted to offer a bank-like product that had the perception of stability in the principal balance, as a bank deposit does, but they didn't want all the regulation that comes with being a traditional FDIC-insured bank. So I think that's the cleanest and easiest fix. Another possibility has been to go ahead and let them keep this stable NAV, so tell investors that their share price will always be $1, even if the investment is worth less than that. but they would also have to have their own capital reserve to come in and fill it in when those assets lose value. So those are kind of the two basic approaches that the SEC has proposed. I think my preference is the floating NAV, but I think either one of them would really go a long way to stabilizing that sector.
Can I ask another question?
Sure. Yeah.
We referred to the bank bailout of the 19 big banks in early 2009. The criterion fixed by the Federal Reserve was that the bank should open up their balance sheets and let the investigators know what their capital requirement would be if the recession were to get worse from 2009 to 2010 to 2011.
Right.
And both Citibank and Bank of America got $45 billion each.
Yes, they did.
Do you sort of feel that the criterions and the implementation were not quite objective?
Well, I do. The problem with the stress test did result in a lot more capital coming into banks, and that was a good thing.
Yeah.
But there's a lot of discretion and judgment on those stress tests. And yes, we did, especially in 2009, it was our suspicion that perhaps some numbers were coming in lower than they should have been. And I think that was the first year the government did it. We were dealing with more distressed institutions. I think the stress tests have gotten better now. There's more public information about it. But then nonetheless, they still are subject to a lot of supervisory discretion. And so that's why it's really important to me to get the rules up, to just have rules that cannot be fudged, that require these banks to hold a lot more capital than they do.
Microphone over there, please.
Thanks for speaking to us. I'd also like to hear a little bit more about the regulation of money market funds. Specifically, what was the outline of the buried proposal you had alluded to earlier? What would be wrong with insuring those deposits, and what the role of industry pushback is in all this?
Right. Well, that would be another option, to just have an insurance program for them and basically make them like a bank. You know, I think that the downside of that is that you're increasing, you know, the government's exposure by having a new category of deposits that the government is guaranteeing. There's a program right now called the Transaction Account Guarantee Program. It was a temporary program for FDIC-insured banks that expires at the end of the year that basically provides unlimited deposit insurance coverage for transaction accounts that don't bear any interest. So especially if large corporate users feel like they need an account like that maintains a stable value for cash management purposes, but obviously they're going to have account balances much higher than $250,000, then maybe we should have some type of insurance program. I'm not sure I like that idea, but you know, because we've got too much guarantees already. But if that's really what they want, then we should do it cleanly. Say the government's going to guarantee it, charge for it the way we do deposit insurance, because now it's the worst of both worlds. They have this implicit government guarantee. Everybody knows the government came in and bailed them out before, but they don't have any of the trade-offs of regulation or capital requirements, or they don't have to pay anything for it either.
Over there, please.
Yeah. So you talked about how a lot of the changes need to come from the public, from the ground up.
Right.
And you said you can really simplify a lot of the stuff. That's one of the things you try to do with your book. But if you look at, like even back when Moody's was rating all these bonds AAA when they really, or 1A, when they really weren't, it is kind of complicated. You have derivatives. How do you propose to get most of the public behind these changes when it's so complicated?
I think you're right. These institutions are too complex, and the regulations we're putting on them are too complex. But I do think, for instance, like an 8% leverage ratio, that's just tangible common equity to total assets. Don't risk weight those assets. Just that basically, and you know, a lot of people would argue for higher. But you know, for every $12 you borrow, you've got to have $1 of your own money in it. I don't think that's hard. You know, I think mortgage lending standards, they made horribly complicated. You need to document your income. You know, you have to have some regional debt-to-income ratio. If it's an adjustable mortgage, you need to make sure that when the payment resets, they can pay it. You know, we've got hundreds of pages of this, and I don't think it should be that hard. Not using insured deposits only for lending activities. I don't think that's hard. I think these derivatives and securities activities may have economic worth. I'm sure they do, but I don't want insured deposits funding them. I think insured deposits have been there traditionally, historically, to support, credit needs, loan support for households and businesses. And so, but I don't think I think there's a tendency, I think complexity is actually a weapon. I think there's a tendency for industry to overcomplicate some of this, and sometimes the regulators walk right into it, like they did with the Volcker rule, to stymie reform. And it can be an intimidation tactic too. Like it's hard for members of Congress. I was critical of them, but there are a lot of really good members of Congress who want to reform the industry too. But they have an oversight hearing to try to ask a question, and you get into the weeds, and they're afraid. They're not sure they understand the subject matter enough. So I think, yes, we have complexity, but a lot of that could be avoided with some pretty simple rules. And leverage is leverage, right? Documenting income is documenting income. It's just not that hard, not as hard as they're making it.
Over there.
Yes, thank you, Chairman Bair, for being here this evening. I was wondering if you could give us your reaction to the discussion of Dodd-Frank in last night's presidential debate, particularly Governor Romney's criticisms of Title I, and kind of broader than that, how can regulators more effectively communicate with politicians to help dispel some of the myths that you've been talking about?
Right. Well, there's a lot of misunderstanding of Title I, and I was disappointed to hear that the allegation was made. I assume he was talking about Title I, that a Title I designation is a too big to fail designation. It's not. It's a penalty box. What the Title I designation says is that you're systemic. We're worried about you. We're going to slap higher capital. We're going to have the Fed examiners go in and look at you. We're going to put liquidity requirements on you. There are going to be a lot of regulatory penalties by being designated as systemic. We're going to make you do living wills and show us that you can be resolved in bankruptcy. If you can't show that to us, we have the power to order you to downsize or restructure yourself. So it's not it's not a good thing to be a Title I designated institution, but this is being turned around to say somehow that this is a too big to fail designation. Dodd-Frank, I fought very hard for this language. Title II bans bailouts. You're going to go to bankruptcy, you're going to go to the Title II FDIC resolution process, but there will be no more taxpayer bailouts. It's just, it's clear, it's in the language of the statute. And I think, Governor Romney and others would like to improve the bankruptcy code so that more financial institutions could go into bankruptcy in a way that would not be disruptive to the rest of us, and I'm all for that. I don't think the FDIC has any interest outside of insured banks to dealing with this, but until you have a bankruptcy code that works, it's good to have this alternative program, because otherwise, if you repeal that, then you're going to have the bailout status quo, and I don't think anybody wants to go back to that.
Over there.
My questions are along the similar line of in Dodd-Frank, and one of the key things you keep hearing is that the cost of regulation, especially to small community banks. And so I was just wondering if you can comment, one, is that true? And second, how do you balance the cost of regulation for a community bank versus a large institution?
Well, it's not true of Dodd-Frank. Dodd-Frank went out of its way to protect smaller institutions, but I do think the regulators in implementation have too often slapped rules on the little banks alongside with the stuff we're trying to get fixed at the big banks. Prime example are the capital standards. We had to wait, it wasn't until March when the capital standards came out, and then they didn't deal just with the systemic institutions. They, rewriting the rules for everybody. And the raising bank capital is not a big deal for community banks because they're small enough to fail, so they have higher capital already. But the complex formulas they were using to set the new capital charges are beyond the ability of community banks and would have significant administrative costs. So I think that was an example of where they unnecessarily went out and kind of put a lot of new stuff on community banks, and it's not quite clear why we need that. Servicing standards is another area where I worry that the agencies, and this is the Consumer Bureau, servicing, the entities that collect the mortgage payments and pass them along to investors and who are responsible for dealing with troubled mortgages when a mortgage becomes delinquent. There's been a lot of dysfunction in the servicing industry, but most of that has been, I think, because of securitized loans. To the securitization process, the entity that owns the loan is different from the entity that actually services, is responsible for getting that loan restructured and trying to mitigate losses. You don't see a lot of problems with portfolio loans. The banks restructure their own. It's when you separate that. And the community banks, they're not servicers for securitization trusts. They have a small portfolio of their own loans they typically service. But we've got lots and lots of pages now, servicing standards that are going to apply to everybody. So I do wish, thank you for asking that question, because I do think the regulators themselves really need to think hard about this and prioritize. And it's the larger financial institutions and some of the things that are going on in their balance sheets that they should be worrying about now.
I think we have time for one more question, so I think it's over on this side.
Hi, actually I have two quick questions. One is that, what do you think about, like, do you think the current regulatory environment will change depending on the election result next month? And also, what do you think about the future of the banking industry, given the fact that most of banks are traded below their book value now?
I'm sorry, was it hard? Did you understand it? I'm sorry, could you repeat it?
Yeah,
the echo is really bad in here.
Yeah, so,
sorry.
So the first question is that, do you think the current regulatory environment will change depending on the election result next month?
Yes.
And the second question is that, what do you think about the future of the banking industry, given the fact that most of the banking stocks are traded below their book value now?
Yeah. So in the first question, whoever is, look, I joke that I'm writing in John Huntsman. You know, he was really the only one who tried to make financial reform as a central issue, and this public confidence issue that is a legacy of the bailouts. I think he was really trying to speak to that, and I haven't heard a lot of that from either candidate. Mr. Obama, I think, talks well about financial reform, but if you see what's happened during his administration, the pace of reform, actually implementing these reforms, has not been good. Plus, you know, I do think in 2009, his economic team continued bailout policies unnecessarily when that was when we should have been imposing some accountability and pain and getting banks to restructure their balance sheets, move their toxic assets off of their books. I think that would have helped our economic recovery. It didn't happen. And their response on housing has been very tepid. They spent very little money on foreclosure prevention. On the other hand, Mr. Romney, I think a lot of, this is a problem more generally with his campaign messaging. He says he wants to repeal Dodd-Frank and replace it, but he really hasn't given us a lot of detail of what he wants to do. And the few things I have heard, like higher capital and risk retention, are already in Dodd-Frank. So I would like, if he wants to replace it, first of all, I wish and hope he would work with it because it's there, it's law, and, you know, we need to get these reforms in place. I don't want to see another 2-year legislative battle on financial reform. That just exacerbates the problem. So I really hope he would think hard about whether Dodd-Frank is given that Dodd-Frank really is just a delegation of authority to regulators, that whether his goals of financial reform cannot be accomplished in that way. So I give them both ambiguous marks at this point. I really do. But again, this is one of the reasons why I really want people to make this an issue, make meaningful reform, and not just talking about it, but actually getting it done. So.
Okay, well, we could go on all night, as you see, but we're going to conclude this evening. There is a reception immediately following in the faculty room, to which you're all invited. But please join me in, again, thanking Sheila for speaking to us tonight and for her very candid remarks. Thank you, Sheila.